And former government chief whips.
Absolutely. I agree with you, Right Honourable Speaker. Right Honourable Speaker, the funeral bill being sponsored by the Ministry of Public Service was brought to Cabinet. Cabinet reviewed it and again sent it back to the first Parliamentary Council to do some bit of surgery. We have a standing rule in Cabinet that it is only bills whose principles are approved by Cabinet that should form part of the legislative agenda of government, because in the past most ministries would send on their list bills that are yet being conceived to be part of the legislative agenda. So once the principles of the proposed law that will highlight the different categories of leaders and what they are entitled to in terms of burials are handled in Cabinet, definitely the bill will come on the floor. Then the members of Parliament will be at liberty to look at the different categories proposed by government. If there are categories that we feel we should include, then it can be included. But before the law is in place, I beg that we allow the President to continue exercising the executive authority. So it is work in progress. The bill is already before Cabinet. Once the principles are done, it will come to Parliament through the Ministry of Public Service. Okay.
Thank you,
Madam Speaker.
honourable members, and that's why I've told our members, let's protect our pension. I have seen members of Parliament, former members of Parliament, who are suffering. But when you get somebody who's earning just mere 2 million shillings out of the pension, the person is very, very happy. Very, very happy. Now, when somebody brought in a bill, who was making a proposal that they want to get 50% of their pension, that people should be allowed to get 50% of their pension. I am sorry, members, we will not allow that. We should be able to differentiate between a pension and a SACCO. We should not do that. And then there is something that, Honorable Minister, that I want you to make a follow-up. Nathan, I want you to listen to this, because you have a lot of money in the pension. How can you people agree in a board that you're going to do an investment, buy a building in town, you don't involve other stakeholders? I am the biggest stakeholder. I give you money, 30% as Parliament. Now you only hear it from the news that we are buying. This money is not your money. These are pensioners' money. So I am the Honourable Minister. No purchase is going to take place until all the stakeholders are involved.
Madam Speaker, I strongly support your position that our pensions should be ring-fenced from us, that we should also be assisted. It should be ring-fenced from us, because from us and for us, because when we are still here, we tend to go a bit insane in facilitating our voters, that we forget ourselves. It took a strong stand to have our salaries as a no-go area for loans. Otherwise, if people had started mortgaging everything theirs and remaining with nothing on their pay slips. So, Madam Speaker, I strongly support you that you move to protect us from us in that direction. I also feel that it is quite unfair for the board to continue doing things on our behalf without your knowledge. But, Madam Speaker, the issue for which I was seeking information from the minister was about the formers who are still in service. I've seen the presidential, the the Ministry of Presidency, ministerial policy statement, with many former prime ministers as president's advisors and earning a salary of up to 20 million, and also are we going to now to give them their benefits as formers when they are still serving us and drawing a salary from the consolidated fund? The same people. If I'm a former speaker and I'm now a prime minister and a minister somewhere else, will I be picking money when I'm still also serving as an advisor to the president, also fetching a monthly salary? I see the former vice president, the former prime minister, Mama Babas, all of them have now turned back as president's advisors. I want to be clarified on that.
Thank you.
Before the minister comes in, Madam Speaker, you have raised a very important point. And I thought that as a student of finance, I should amplify your point. When you are looking at investments, especially investing money for the circle, whose membership?
For the pensioners.
For the pensioners. You have to look at what we call the age liability profile. If you are going to invest into an asset that is going to bring, whose rate of return or payback period
the return
is
on investment.
Yes, is likely to go beyond the lifetime of the pensioner whom you are investing for, then it is unlikely that that person will benefit from that rate of return. Therefore, I want to agree with you that when the boards are making decisions, they must be mindful that someone must enjoy his return in his lifetime. If I am 70-year-old and you are going to invest into a building that is going to bring return after 40 years, then it is not in my interest. Therefore, I agree with you.
But also, Honorable Katesh,
Yes.
you first need to look at how many members of parliament have left parliament and are going to withdraw all their savings.
Yes.
Because when you're a first timer, you're allowed to take all your savings. So,
but, Madam Speaker, that's why there has to be a careful analysis of the age liability profile. At the same time, look at the lifetime of the members of parliament, especially in their positions. You cannot invest as if you are investing for an 18-year-old who perhaps has more years to live and enjoy his benefits.
True. Thank you.
On those things of annuity and what you are talking about investment, withdrawing a pension is at the age. That's why public service says the moment you make 60, you retire. Then they pay you your gratuity and your pension because they know you are remaining with very few years. So, Madam Speaker, I think also, as you raised the issue of investment, whom are you investing for in the building? Are you investing for the new members of parliament, or you are investing for the old ones, or and at what age?
Exactly.
And if you are investing for the old ones who are remaining with a very few years on earth, that building is not worth it for them. In fact, for them, what is worth it are quick liquidity process like treasury bills, which are for 90 days, because anytime somebody can go, you need to pay his what? His money. And also, by the way, Madam Speaker, when you raise that those who are going to get 50 or less and whatever, it depends. If I have invested my money and I see the returns by the others in that law, that you are not giving me a nice return, I can say, please, I want to direct you, take my money to this X place where I'll get a better what? A better return. From what I'm seeing from the pension, the return we're getting, Madam Speaker, is not worth it. And the reason why it's not worth it is because they're investing in the treasury.
Procedure. I thought you are the ones who started that pension scheme. No. Yes.
Madam Speaker, we debated here and passed the Pension Act. We also have the authority to amend it if we so wish. And the pension is a very, very, very serious issue. Are we really procedure right, especially my brother, to want us to debate this important matter of pension in a very casual manner like this, when we have the opportunity to bring amendments, when we have the thank you. Are we proceeding well, given that we have the income tax amendment bill on the order paper?
Now, Honorable Nathan, if you think it is not doing well, we'll get time and do that amendment. So for now, let's go to the next item. Next item.
Madam Speaker, it is fair that I also say something on this matter. Now, 2 points. One, actually 3. My first point, I can start with the building. I am a trustee in the Parliamentary Pension Scheme, representing Ministry of Finance. We have been discussing this investment. Madam Speaker, apparently the law allows us to determine asset classes, and the asset classes are fixed income. We also invest in equities, and also real estate is also one of the allowable asset classes. But on real estate, we have been going slow. We have not, I think this is the first time we are considering making a decision to invest in real estate. But I must admit, in the first meetings I was attending, until when I became busy with elections, and after elections the budget, so I have not attended the last meetings. What I can commit is that since we do this on your behalf, if you feel we should involve you more or go slow in paying or investing in real estate, we can come back to this decision. Madam Speaker, it is not late. My point 2 is on drawing a pension up to 50%. Madam Speaker, the principle of pension is that you save money to help you in old age when you are no longer working. So when you begin, first of all, even mid-term access was not correct. Then we go further and now seek to draw up to 50%. We would have defeated the objective of saving for old age, Madam Speaker. Now, finally, the pension scheme has its governing law. It's separate from public service pension, NSSF, and others. This one is governed by the Pension Act of Parliament. So it defines whatever we are doing in the scheme is in accordance with the law of Parliamentary Pensions Act. And my last point is that what Honorable Katesh is talking about, the laws, some laws laws define how to access pension differently. So like this one says, if you are a pensioner, we will pay you, if you are 45 and above, we will pay you for 15 years. Either you are 45, you are 60, or whatever. We will pay you pension for 15 years. Why do we assume like that? We assume that 15 years after getting out of Parliament, within 15 years, you die. So, but if you continue, no, you don't, I can say your life comes to an end. So if you don't die, we will pay you until when you die. But the risk there, many will have died. the risk there is small. Those who will remain after 15 years will not be many and can be accommodated. Finally, Madam Speaker, let me undertake that I am going to immediately call my chairman, Honorable Alinito Gwakajara, and also the CEO of the pension scheme, that it is a considered opinion of Parliament that we should study further this decision of investing in real estate. Thank you, Right Honorable Speaker.
Thank you so much. Former.
Madam Speaker, I am happy that the principal legal advisor of government is now here, the Attorney General. In response to the matter raised by the Honorable Namboze, our learned friends keep telling us two things in law. That one, whatever is not prohibited by law is allowed. And two, that the law is interpreted as it is, not as it ought to be or as you wish it to be. Now, on the subject matter raised by the Honorable Namboze, the law as it is allows the former holder of the office of Prime Minister, Deputy Speaker of Parliament, Speaker of Parliament, Vice President of Uganda, and the President of Uganda to enjoy the benefit. President is served as Speaker, is equally enjoying the privileges of the office of a former Speaker. He is served as Deputy Speaker, is equally enjoying the privileges of the office of a former Deputy Speaker of Parliament. Now, that is the law as it is. Yes, because he is being paid for holding that office. He is a former holder of that office. So the law did not envisage the fact that if this person is appointed into another office where he or she draws his or her salaries from the consolidated fund, what must be done? So that is the position of the law. Until it is amended, they will continue to enjoy those privileges and benefits attached to the holder of those offices in their former capacities. Thank you.
Is that cleared? Madam,
with your indulgence,
we are not amending that law. Let's leave it as it is. Next item. Next item.
Item 3 on the order paper, Bill second reading, the Income Tax Amendment Bill 2026.
Honorable members, pursuant to Rule 136(1) of the Rules of Procedure of Parliament, I want to invite the Minister of Finance, Planning and Economic Development to move a motion for the second reading of the bill.
Right Honorable Speaker and colleagues, I beg to move a motion that the Income Tax Amendment Bill 2026 be read for the second time. I beg to move.
Seconded by Honorable Bua, Honorable Bahati, Honorable Amos, Katesh, Honorable Kasai, Betty, Honorable Betty, Honorable Zijan, Honorable Mpindi, Honorable Mukono Haji, Ali Haji, Honorable Lucy, Honorable Faith, Honorable Mudimi, Honorable Baka, Honorable Noelin, Honorable John, and Honorable Kubex. Justify.
Thank you, Right Honorable Speaker. Right Honorable Speaker, the Income Tax Amendment Bill 6 is seeking to amend the Income Tax Act, Cap 338, to provide for withholding tax on interest paid by a resident company to a foreign financial institution, on commissions paid to telecommunication retail services, mobile network services, or provision of mobile money services, on winnings under gaming or betting, on payment for the purchase of non-business assets, and on payment to public entertainers, to exempt the income of the Bujagali hydropower project and the income of a developer of a hotel or tourism facility from tax, to amend Schedule 2 to provide for the Arab Bank for Economic Development in Africa, BADEA, and the Uganda Red Cross Society as listed institutions, and to amend Schedule 4 of the Act to revise certain tax rates and for other related matters. I submit for the consideration of the House, Right Honorable Speaker.
Thank you. I am also aware that the report from the committee is ready and is accompanied with a minority report. So can we have the report from the chair, and then we shall have from the minority member. Attorney General, welcome back. We missed you.
Right Honorable Speaker and Honorable colleagues, as you have put it, and rightly so, the committee is ready to report. It was actually ready even on Tuesday, but because of time schedule. So I would like to beg that I lay on table the copies and minutes and documents that were reviewed for these last two tax bills at once, the Income Tax Amendment Bill and the Rotaries and Gaming Amendment Bill 2026. But for now, I'll go straight to the Income Tax Amendment Bill. Right Honorable Speaker and colleagues, the committee was consistent in terms of the reporting. The introduction is very clear. The object of the bill is clear. The methodology and meetings that were carried out, the document review, and all those were consistent like they were in the previous bills that were tabled. Right Honorable Speaker, allow me to go specifically to areas of observation and recommendation. I'll start with Clause 2 of the bill, which seeks to amend Section 2 of the Income Tax Act, Cap 338, to provide for software in the definition of the word royalty. The proposed amendment thus indicates that software is now explicitly royalties attracting withholding tax. The Ministry informed the committee that the amendment aligns Uganda's tax treatment with international standards including the ESC Treaty and the UN Model Tax Convention, which treats software payments as royalties in order to allow countries which import software to tax the payment on gross basis. The committee observed that the software is a key service paid for under cross-border services in a globalized economy. Software can be imported either embedded in a physical device or assessed digitally. The proposed amendment seeks to expand the tax base to include both categories. The committee recommends that Clause 2 be adopted. Disposal of non-business assets, Clause 3. The bill seeks to include income derived from the disposal of non-business assets as property income. Section 20 of the Income Tax Act provides for different types of property income. This means that when one disposes a non-business asset, the person purchasing the non-business asset will be required to withhold 6% of the gross payment as proposed under Clause 13 of the bill. The committee learned that the amendment ensures that income from the sale of non-business assets such as land, jewelry, shares, and precious metal is recognized as a taxable income under the Act. It is necessary to support the proposed withholding tax in clause 13 of the bill on such transactions, since the income must first form part of the gross income to be chargeable to tax. Currently, capital gains tax mainly applies to business assets, with gains tax as part of the business income. Non-business assets are largely outside this framework and creates a gap in the tax system. The proposal addresses this gap by bringing non-business asset disposal into a tax base. The committee observed as follows. 1. The term non-business asset is not defined in the bill, leaving it to the wide interpretation. There is need to specify what a non-business asset is, other than defining it by way of exclusion from the business asset. A business asset is defined under Section 2 of the Act to mean an asset which is used or held ready for use in a business, and includes any asset held for sale in a business and any asset of a partnership or company. 2. Implication of this tax may face considerable challenges, as it is difficult to determine when one sells a non-business asset. And 3, the committee continues to observe that the traceability of the transactions involving non-business assets, such as unregistered land, jewelry, among others, will be difficult, thereby complicating administration of such a tax. And 4, there is need to consider the purpose of sale of a non-business asset, as the imposition of the withholding tax may not enable citizens to achieve the intended purpose of sale. And lastly, the committee observed a taxpayer who, for different reasons, sells land below the market value will incur a tax obligation which ordinarily should not exist. The committee recommends that clause 3 of the bill be deleted. Exemption of Bujagali Hydro Project. Clause 4A I of the bill seeks to amend 21(1)AB to extend the exemption of the income of Bujagali Hydro Power Project by 6 years from 30th June 2026 to 30th June 2032. The ministry indicated that the exemption in the current law is set to expire on the 30th of June 2026. The proposed extension is based on the structure of the Bujagali Agreement, where corporate income tax is built into the electricity tariff. If the tax is imposed, the tariff will automatically increase to cover the tax costs. This means that taxing the projects would lead to high electricity prices for consumers rather than generating real net revenue for government. In 2025, the Committee of Finance recommended in its report that the Bujagali Hydropower project be exempted from income tax for the 7 years period as proposed in the bill, to be consistent with the power purchase agreement, which runs up to 2032. And on the 14th May 2025, Parliament debated the Income Tax Amendment Bill 2025 and rejected the committee's 7 years, recommending that they instead give a 1-year exemption. I hereby report the observations of the committee. In 2017, the Bujagali generation tariff was at 13 cents US dollars, which was so high. The government, in a renegotiation, offered to waive corporate income tax for 5 years in exchange for a reduction of the generation tariff to 8.3 cents. The Bujagali generation tariff as at March 2026 was at 6.34. Colleagues, you can see the reduction because of the exemptions we've been giving, with a dispatch of 84.1%. 2, if the amendment is rejected, income tax, according to the renegotiation power purchase agreement, shall automatically pass through into a tariff as a cost ranging between 1.8 to 2, and therefore will increase the cost of power. The proposed amendment seeks to give a waiver to Bujagali up to 2032. This implies that after 2031, the tariff application should only be between 4.5 to 4.7 cents per kWh US dollars, lower than the current tariff of Isimba and Karuma. The committee therefore recommends that this clause 4A of the bill be adopted. Correction of the typographical error. Clause 4A2 seeks to correct a typographic error under section 2, 1AE and 7 of the CAP 338. The section provides the tax exemption for income derived from specific activities, specifically manufacturers of chemical for agriculture use, industrial use, textile, glassware, leather products, industrial machinery, electronic equipment, sanitary pads, and for diapers. The proposed amendment is to delete the word for. The committee observes that the proposed amendment is a correct or clarification intended to correct technical or clerical errors in this section. The committee recommends that this clause be adopted. Exemption of income of a developer of a hotel or tourism facility. Colleagues, you remember in the previous bills this was talked about, so they are cross-cutting. Clause 4A3 of the bill seeks to amend Section 21 of the Income Tax Act by inserting in subsection 1 a new paragraph AH. The proposal intends to exempt a hotel or tourism facility developer from tax subject to the conditions specified in the provision. In order for a hotel or tourism facility developer to benefit from the exemptions, the following must be in place. 1, the investment capital should be at least 10 million United States US dollars in the case of a foreigner, or 5 million US dollars in case of a citizen. Subject to availability, the developer should use at least 7% of the locally sourced raw materials. 3, the developer should employ at least 20% of its employees who are citizens, earning an aggregated wage of at least 70% of the total wage bill. According to the ministry, this measure is designed to attract investments in high-quality hotels, create jobs, and support Uganda's tourism sector. It also aligns with the government's tenfold growth strategy, especially in promoting the ATMs. The committee observes that the amendment will promote investment in the tourism industry in Uganda. The minimum threshold for investment by citizens set at 5 million US dollars is so high for a typical Ugandan developer to mobilize financing and deliver the project on the time prescribed in the bill. Whereas the ministry did not propose a timeline for implementation of the project under the Income Tax Amendment Bill 2026, the committee found that most hotels' constructions take an average of 5 years to be completed. And as such, there is a need to prescribe a timeline for the proposed exemption. To ensure that Ugandan developers benefit from this amendment, the investment capital should be reduced to US dollars 1.5 million for the citizens, and the requirement under the proposal for the developer to use locally sourced raw materials and the employment of citizens promotes local content and ensures citizens of employment opportunities. The committee recommends that clause 4A3 of the bill be passed with amendments to reduce the threshold to 1.5 million US dollars for locals, the citizens, and include a period of 5 years within which the beneficiary must have completed setting up the facility. Infrastructure bond. Clause 4B of the bill intends to amend Section 21(7) to change the definition of the infrastructure bond to include all bonds as proposed to only listed bonds. The Finance Ministry stated that the key change is that the bond will no longer need to be listed on the stock exchange to qualify. Currently, this requirement limits how government can raise funds and creates uncertainty. By removing the listing requirement, the proposal makes it easier for government to mobilize financing and allows these bonds to be traded more freely even outside the stock exchange. The committee observed that the inclusion of all bonds will make it easier for government to mobilize financing. The committee therefore recommends that clause 4B be adopted. Allowable deductions for bad debts. Clause 5 seeks to amend Section 24 to allow microfinance deposit-taking institutions or Tier 4 microfinance institutions to claim deductions for bad debts just like other financial institutions. According to the ministry, this amendment allows microfinance Tier 4 institutions to claim deductions for bad debts and provides for bad debts made in accordance with the financial regulatory requirements, and currently the law permits such deductions for supervised financial institutions but does not extend the same treatment to microfinance and Tier 4 institutions. This proposed change aligns the tax treatment of microfinance institutions with that of other regulated financial institutions. It means and ensures fairness is recognized the similar regulatory obligations they face. That microfinance deposit-taking institutions and Tier 4 microfinance institutions are relevant in Uganda and serve as the primary access points for underserved rural and informal sectors, and as such, they should be allowed to claim under this section. The committee recommends that the clause be adopted. Deductions of interest incurred on debt obligations. Clause 6 of the bill seeks to amend Section 25 of the Act to include the definition of dormant and amend the definition of group and tax earnings before interest, tax, depreciation, and amortization. The definition of group is proposed to include a person other than an individual with at least 51% of the common underlying ownership and excludes a member of the group that is dormant. The definition of tax earnings before interest, tax, depreciation, and amortization is proposed as the sum of the gross income less allowable deductions other than brought forward losses. The ministry stated that this proposal intends to simplify and clarify how interest expenses are treated for tax purposes. First, the proposed definition of dormant company as one that is not doing business and has no financial activity in a year. Such companies should be ignored when applying the rule. And second, it defines a group as a company, as companies rather, that are at least 51% interest of the common underlying ownership. Only active companies are included. This makes it clear which businesses are treated as related. Third, it explains how to calculate EBITDA, earnings before interest, tax, depreciation, and amortization, which is a measure of business performance. It focuses only on current year, including expenses, and excludes old losses brought forward from previous years. The committee was further informed that under the current law, companies that are members of a group can deduct interest on loans, but this is limited to 30% of the EBITDA if the company is part of a group. This rule prevents group companies from using too much borrowing to reduce their tax. This is something they are able to do by virtue of being in a group. The committee observed that 1. Amending the definition simplifies the application of the 30% interest limitation rule by excluding dormant companies that have no real economic activity from the group calculations, making the rule easier to apply. And 2, it reduces unnecessary compliance burden on genuine companies which have not had no real economic activity in a year. The committee recommends the clause 6 of the bill be adopted. Expenditure incurred by a person in acquiring farm works. Clause 7 of the bill seeks to amend Section 34 of the Act. It is to the effect that expenditure incurred by a person in acquiring farm works is included in the personal pool for Class 3 assets in a year of income, in which the expenditure is incurred and depreciated accordingly under Section 27. Under Income Tax Amendment Act 2021, the class of assets under the Principal Act was amended from Class 4 to Class 3. Section 27(2) provides that depreciable assets are classified into 3 classes as set out in Part 1 of the Schedule 7 to the Principal Act, with depreciation rates applicable for each class as specified in that part. The Ministry indicated that this change is needed because the law was amended in July 2021 to reduce asset categories from 4 classes to 3. As a result, Class 4 no longer exists. This amendment simply updates the law to reflect the current classification system and avoid confusion when applying the rules. The committee observed that the continued reflection of Class 4 assets in the Principal Act, which no longer exists, poses challenges during tax administration, and therefore the committee recommends that Clause 7 be adopted. Carry forward losses. Clause 8 of the bill seeks to amend Section 36 of the Act to introduce a minimum tax on carry forward losses. Currently, a taxpayer who, after a period of 7 years of income, carries forward assessed losses is only allowed to deduct 50% of the losses carried forward in the following income year, and subsequent years of income in determining the taxpayer's chargeable income. The proposed amendment is to the effect that a taxpayer who, after a period of 7 years of income, carries forward assessed losses shall pay a tax at a rate of 0.5% on the gross income of the taxpayer or the tax charged under Section 4, subsection 1, whichever is higher. The Ministry informed the committee that currently the law limits the use of carried forward losses after 7 years to 50%. But it does not impose any further consequence. As a result, some companies may continue reporting low or no taxable income for many years. The proposed amendment ensures that such businesses still make a minimum contribution to government revenue. Instead of paying no tax, they will pay at least 0.5% of their gross income. The proposed amendment ensures that such businesses still make a minimum contribution to government revenue. In simple terms, a company will either pay the normal tax of 30% on its profits, or, if it continues to report losses, a small tax based on its turnover. The committee observed that if this amendment is applied across the board, it may result in closure of several businesses which it is targeting to tax gross income as opposed to profit. 2, where a company is genuinely incurring losses, it will be required to pay tax. Whereas the proposal is seeking to capture companies which are practicing tax planning through practices such as declaration of losses, some companies which are genuinely incurring losses will be disadvantaged. And 3, the amendment amounts to taxation of gross income as opposed to profits, and therefore defeats the principle of income tax. The committee recommends that Clause 8 of the bill be deleted. Tax on international payments, Clause 9. Clause 9 of the bill seeks to amend Section 82 of the Act, which exempts interest paid by a resident company in respect of debenture upon fulfilling the stated condition. The amendment seeks to impose withholding tax on the gross amount of the interest paid in respect of debentures by a resident company. The interest is at a rate of 5% as proposed under Part 5 of Schedule 4 of this Act. The Minister stated that currently, when a Ugandan company borrows from foreign bank or financial institution, it does not withhold tax on the interest it pays. This means that income earned from Uganda may go untaxed in Uganda. The amendment introduces a 5% withholding tax to ensure that this income contributes to Uganda's tax revenue, just like interest earned by financial institutions within the country. The committee observed that the interest to be withheld is derived from income generated in Uganda and as such should be taxed within the Uganda jurisdiction. The committee recommends that Clause 9 of the bill be adopted. Taxation of non-resident providing digital services. Clause 10 of the bill proposes an amendment of Section 86 of the Act by exempting the income attributable to royalties from taxation under taxation of non-residents providing digital services. This means that a person who derives income from providing digital services in Uganda, which services are attributable to royalties, the person will not pay tax under Section 86. This is because the person will be required to pay tax under Section 82, and Section 82 provides for payment of tax on royalties. The definition of royalties is provided for under Section 2 of the Principal Act, and the bill proposes an amendment to that section provide for software under royalties. The minister stated that this amendment aligns Clause 2 of the bill, which includes software in the definition of royalties, and software can be categorized as a digital service such as double taxation is avoided. The committee observed that the amendment intends to avoid double taxation by disapplying Section 86 from income attributable to royalties. The committee recommends that Clause 10 be adopted. Arm's length principle, which is Clause 11. Clause 11 of the bill seeks to insert a new section 115A in the Principal Act to provide for the arm's length principle in controlled transactions or a series of controlled transactions. Controlled transactions is defined in the bill to mean transactions between associates. According to the ministry, honorable colleagues, the arm's length principle means that related parties must deal with each other as if they were independent, using market prices and terms. The amendment places a clear obligation on the taxpayer to to demonstrate that their related party transactions meet this standard. Previously, some taxpayers relied on gaps in the law to avoid providing sufficient evidence, making it difficult for URA to assess whether transactions were fairly priced. The committee observed that the provision intends to require persons to account for controlled transactions. Section 116 only requires the Commissioner General to distribute a portion or allocate income as well as deductions or credit between associates to reflect the chargeable income realized by a taxpayer in an arm's length transaction. The committee recommends that Clause 11 be adopted. Rental tax. Clause 12. Clause 12 of the bill seeks to amend Section 124 of the Act to enable individual taxpayers to furnish optional provisional returns of the rental income tax on a monthly basis. According to the ministry, this allows an individual rental taxpayer to file and pay rental tax on a monthly basis if they choose to do so. Currently, individuals are required to declare and pay their rental tax quarterly. The proposed amendment does not replace this system, but introduces an optional alternative. The taxpayers may continue with quarterly filings where it is more convenient, or opt for monthly filing depending on the circumstances. Now, the committee observed that since the proposed amendment is optional, it is giving taxpayers an alternative of paying their tax and still ensures compliance. The committee recommends that this clause be adopted. Withholding tax by purchaser of assets. Clause 13 of the bill seeks to amend Section 130 of the Act, which provides for withholding tax by purchaser of non-business asset. The proposal provides for the rate of a non-business asset, which has been provided for under Clause 3 of the bill. The proposed amendment seeks to provide for the withholding tax rate for purchase of non-business assets of 6%. of the gross payment as specified in Part 10 of Schedule 4. The committee observed that Part 10 of the Schedule 4 of the Act provides a rate of 10%. For purposes of Section 130, withholding tax for purchase of an asset, the committee recommends the deletion of Clause 3 of the bill, and as such, this is a consequential amendment. The committee recommends that Clause 13 of the bill be deleted following the deletion of Clause 3 of the bill. Withholding tax on payment of winnings or winnings of betting or gaming. Clause 14 of the bill seeks to substitute Section 131 to expound the provisions for withholding tax on payment of winnings or betting or gaming. The proposed amendment prescribes withholding tax on winnings at 15% under Part 11 of Schedule 4 and defines winnings as the difference between payouts and the stakes amounts on the game or bet, and further exempts winnings paid by a person licensed to conduct national lottery. The ministry stated that this amendment requires a betting or gaming company which pays out winnings from betting or gaming to withhold at a rate of 15%. Winnings are defined as the amount paid out to the player minus the amount they staked. This ensures that tax is applied only to the actual gain, not the total payout. Currently, withholding only applies to winnings from betting. The proposal extends withholding tax to gaming and defines what winnings are. The committee observed the tax intends to include gaming which was not previously provided for, and 2, the definition of winnings provides clarity which will ensure tax administration, and 3, there is need to disapply withholding tax from winnings arising by playing card games or roulette. Card games and roulette is termed as land-based games. The committee recommends that Clause 14 be adopted with the proposed amendments. Withholding tax on commission paid by communication service providers. Clause 15 of the bill intends to substitute Section 133 for withholding tax to apply to commission of telecommunication, retail services, and mobile network services, and omits airtime distribution from the provision. The ministry informed the committee that the proposed amendment expands this source to include commissions earned by agents distributing other telecom products such as voice and data bundles. The tax is charged on gross amounts of the commissions paid, making it easier to administer and enforce. The object of this amendment is to widen the tax base and reduce tax avoidance within the telecommunication sector. Where some commission income may not be fully declared, the object of this amendment is to widen the tax base and reduce tax avoidance within the telecommunication sector, where some commission income may not be fully declared. By aims to improve compliance and increase revenue collection. The committee observed that the amendment intends to incorporate changes in the telecommunication sector in order to widen the tax base. The committee recommends that Clause 15 be adopted. Withholding tax on public entertainer. Clause 16 of the bill provides to insert Clause 135B to withhold tax on the gross payment of a public entertainer. The finance minister explained that the amendment requires any person who pays a public entertainer to withhold the tax at a rate of 6% on the gross payment, as proposed under Part 16 of Schedule 4. Currently, withholding tax mainly applies to payment made by designated agents and commissions in sectors such as insurance, advertising, and mobile money. This leaves a gap where payments for entertainers are not consistently taxed. especially when made to promoters or other players who are not designated agents. The proposed amendment closes this gap by placing the obligation to withhold on anyone making payment to an entertainer. This ensures that income earned by entertainers is captured at source. Improving compliance and reducing the risk of under-reporting, the committee therefore observed as follows. There is a need to define the word public entertainer. And 2, there may be implementation challenges in traceability in the transaction and payment. The committee recommends that Clause 16 of the bill be adopted with the proposed amendments. Withholding tax as final tax. Clause 17 of the bill seeks to amend Section 139 to provide for tax which has been withheld on payment for purchase of non-business assets. Section 130, subsection 3, on payment of commission paid to insurance agents. Section 134, and on payment of a commission for telecom retail services. Section 133, shall be treated as the final tax, and no further tax liability is imposed upon the taxpayer in respect of the income to which the tax relates. The ministry informed the committee that under the current law, withholding tax on insurance agents' commissions is credited rather than final. This means that the agents must still file tax returns. Many insurance agents incur daily expenses that are informal and difficult to document, making accurate reporting challenging. The proposed amendment simplifies this process by treating the 10% withholding tax as the final tax liability. This removes the need for further filing and reduces the administrative burden on agents. The committee observed that this is a consequential amendment arising from the amendment of Section 130, subsection 3, 133, which has been proposed for amendment in this bill. Clause 17, A and AA, subsection AA, in regard to Section 130, subsection 3, was deleted as a consequential amendment from the deletion of Clause 3 of the bill. And 2, the amendment also seeks to include payment of commission to an insurance agent as a final tax. The committee recommends that Clause 17 of the bill be adopted with the proposed amendments. Tax rate on income derived from resident individuals from foreign source. Clause 18 of the bill seeks to provide for a new insertion of Section 150A to provide that income derived by a resident individual from a foreign source shall be taxed at the same rate as that applies to the same type of income sourced in Uganda. The minister informed the committee that this reform aligns the treatment of foreign income with domestic income by taxing it according to its nature. Although Ugandan law already allows taxation of worldwide income for residents, enforcement has been limited due to difficulties in identifying such income. The adoption of automatic exchange of information now enables Uganda to receive financial information from other countries, making it easier to detect income and abroad. The committee observed that the provision does not take into account cases where income was earned abroad based on tax exemption and bilateral international trade agreements. The committee recommends that this clause be deleted. Clause 19. The bill seeks to amend Schedule 2 of the Act to provide for income tax exemption from the Arab Bank for Economic Development in Africa, Uganda Red Cross Society. Schedule 2 provides for listed institutions which are exempted from, I think, colleagues, you can read that. And the committee recommends that these two entities are known for purposes of mentioned by Minister of Finance, and as such should qualify for exemption. The committee therefore recommends that Clause 19 of the bill be adopted. Clause 20 proposes to amend Schedule 4 by substituting Part 1. Schedule 4 provides for rates of tax. Part 1 of Schedule 4 provides for rates of income tax for individuals. The Finance Ministry informed the committee that a key reform is the increase in the tax-free threshold from 2,820,000 per year to 4,020,000 shillings per year. This is, if you divide it, of course, 2,820,000 is equivalent to 235,000 Uganda shillings per month, and 4.02 million per year means a threshold of 335 per month. The previous threshold, set in 2012, had not been adjusted for inflation despite rising living costs. The purpose of this change is to reduce the tax burden on how income earners and improve fairness on the tax system. By raising the threshold, more individuals will either pay less tax or be removed from the tax net entirely. At the same rate, the progressive structure ensures that high-income earners continue to contribute a larger share of tax revenue. The committee observed as follows. 1. All salary bands stand to be benefiting from the proposed amendment. The tax-free threshold has been increased from 235,000 per month to 335,000 per month, moving lower paid workers from the tax net entirely and providing meaningful disposable income. It corrects the long-standing erosion of tax-free threshold caused by inflation since 2012, restoring fairness for the low segment of the formal sector workers in line with government objective of protecting low-income earners. The committee recommends that Clause 20A stands part of the bill. Withholding tax rates. Clause 20B. The bill proposes to amend income tax in Schedule 4 by inserting Section 2A in Part 5 to provide that the withholding tax rate on the interest paid by the resident company in respect of the debentures to a non-resident person under Section 82(5) is 5%. Clause 20C of the bill proposes an amendment of income tax withholding tax for Section 130, subsection 3 as 6% of the gross payment. Clause 20D of the bill proposes to amend the Income Tax Act in Schedule 4 by substituting Part 11 to provide withholding tax rate for winnings from betting and gaming as 15%. Clause 20E proposes to amend Income Tax Act in Schedule 4 by substituting Part 8 to provide for the rate of withholding tax on payments of commission paid by telecommunication service providers for telecom retail services, mobile network services, or provision of mobile money services at a rate of 10% of the gross amount of payment. Clause 20F provides for Part 16, which provides for withholding tax on payment made to the public entertainer of 6% of the gross payment. The committee observed that the clause provides for withholding tax rates, which has been provided for under the bill. And 2, Clause 20C should be deleted because it is a consequential amendment following deletion of Clause 3. The committee recommends that Clause 20 of the bill be adopted with the proposed amendments. In conclusion, the committee recommends that the bill be passed subject to the proposed amendments. I beg to submit, Right Honourable Speaker and colleagues.
Thank you so much, Chairman. Yes, minority.
Thank you.
Can I have a copy?
Thank you very much, Right Honourable Speaker. We did submit the copies. I think it is even uploaded with the Office of the Clerk. Thank you very much, Right Honourable Speaker. I'm presenting the minority report on the income tax amendment bill. And this minority report is signed by me, Honorable Hanifa Nabukera, Honorable Ibrahim Semujunganda, Honorable Anna Adeke Ebaju, Honorable Brenda Nabukenya, and Honorable Ekanya Geoffrey. At the time of making this minority report, Right Honorable, we had not agreed on certain clauses with the committee, but I'm happy that the chair came to our conclusion on some of the clauses which are included in our minority report. And I'll try to be brief and skip some of these items. When you look at page 1, the issue of non-compliance that was mentioned earlier on Tuesday, the issue of no comprehensive taxation policy that was discussed as well. I'll go to the next page on the issue of the disposal of non-business assets. The law wants to make gains from the disposal of non-business assets officially recognized as derived income, and a person purchasing such an asset be compelled to withhold tax. Right Honorable Speaker, we object to government's introduction or introducing a capital gains tax of 6% withholding tax on private assets like private land, real estate, or shares not listed under an active business, to personal home items like necklaces, television sets, beds, or furniture in homes. This bill, once passed as is, will require that the buyer acts as a tax agent and withhold 6% of the payment and remit it to URA. Right Honorable Speaker, non-business assets are not used to generate income and are normally disposed of for purely personal reasons like settling medical bills, fees, and should not be considered as items to be put under the tax base. The next one is about charging mobile money commission and telecom commissions. We object to the withholding, the withholding tax that they do propose on the commission paid to telecommunication retailers, mobile money networks, and mobile money services. Doing so will directly hit the mobile money agents and airtime vendors. The net take-home profit for small-scale mobile money agents will be affected. Consequently, the mobile money agents will push the costs to the consumer or close operations of mobile kiosks. The other issue is the issue concerning Bujagali. We do reject the proposal to extend the exemption of Bujagali. And this matter has been coming up in each financial. Bujagali tax exemption of 6 years to 30th of June 2032, we do reject it. The Bujagali tax exemption is a matter that tests the integrity of this parliament. While painfully giving a 1-year tax exemption, this current financial, Parliament unanimously resolved that the government renegotiates the power purchase agreement with the Bujagali owners. Parliament also ordered the Auditor General to audit Bujagali, especially in relation to the recommendation of the ad hoc committee report, which report the Auditor General produced. And I think my colleague Honorable Katesh chaired this committee, which I was part of. The 2023 Auditor General's report, and Parliament adopted it. The 2023 Auditor General's report mentions losses of government revenue through exemptions like this one in waivers. The proposed extension of Bujagali tax waiver is projected to result in additional revenue loss of 690 billion shillings in the next 6 financial years. Considering that Bujagali will be forgiven about 115 billion shillings per year up to 2032. We therefore reject the proposal because the project has benefited from repetitive extensions through the annual and short-term amendments. We agree with the proposal to adopt a clear transitional strategy to phase out the exemption, including renegotiating elements of the tariff structure where necessary, or replacing the tax holiday with targeted and transparent subsidies that support electricity affordability without undermining revenue mobilization. I'm going to skip the issue of hotels because this is a consequential amendment to what we discussed on the other day. We were proposing still the 500 threshold, $500,000 US, and 1.5 for the urban settings. The next issue concerns imposing a 0.5 tax on gross income of companies carrying forward assessed losses after a period of 7 consecutive years. Imposing tax of 0.5 on the gross income implies that companies with nil chargeable income will be paying tax, which is against the known principles that corporate income tax is charged on chargeable income. Right Honorable Speaker and members, it is very unrealistic to tax already struggling companies making losses. Government must appreciate that despite such companies making losses in the medium term, they do provide jobs, contribute revenue to URA through pay. Imposing this unpopular tax will definitely affect investment. Section 8 of the bill trying to amend Section 34 of the Principal Act be deleted. That's our recommendation. And we gave an example of Uganda Airlines. Uganda Airlines is a loss-making government entity which has been making losses since its inception over 7 years ago. So government is saying if Uganda Airlines you've made, for example, currently, if Uganda Airlines you've made these losses, then currently you're supposed to pay a tax on your gross sales, whatever Uganda Airlines is making, which is against any known principle, and we do object this because companies can make losses to even up to 10 years, and URA has capacity to determine this. The 7th issue in our report on workers earning income, and our recommendation, because we had a wider interaction, we've proposed a table as you can see it, and we are looking at someone who is earning between 300. The difference there with the committee recommendation is, for us, we are looking at someone earning between 335 to 410 to also be considered at a zero rate. And then someone who is earning over 10 million shillings, the committee recommending what government had proposed, that person is still taxed at roughly about 40% when you do compute. And our proposal is, instead of the 10, to look at someone who is earning 17.4 million. So those are the two differences between the committee recommendation and ours. Right Honorable Speaker and members, the growth in consumer price index between July 2012, we are looking at 2012 because this is when the last rates were set, and February 2026 is about 74%, the equivalent of the tax-free of 235 threshold, adjusted to inflation would be about 408,000. So our view is someone who was earning 235,000 in 2012 is equivalent to someone earning 408,000 today. Someone who was earning 10 million shillings in 2012 is the same as someone who is earning 17.4 million shillings as of today. Right Honorable Speaker and members, to arrive at 74% cumulative growth rate is by compounding the annual inflation rate over the specific period between 2012 and 2026. The average annual inflation between 2012 and 2026 is between 3% and 6%. The compounding effect, if you assume the average annual inflation rate of approximately 4.1% over the period of 13.6 years between July 2012 and February 2026, the cumulative increase in price level reaches approximately 74%. Right Honorable Speaker, it is important to adjust tax brackets for inflation on annual basis based on the consumer price index published by the Uganda Bureau of Statistics at the end of each financial year. We reject the 40% on 10 million, and we do recommend 40% to begin from an income of 17.4 per month. Our 8th proposal, or our 8th view as a minority, is the amendment of Section 82 of the Principal Act. Right Honorable Speaker, the Income Tax Amendment Bill 2026 proposes to amend Section 82 to withhold tax on the gross amount of interest at the rate specified in Part 5 of Schedule 4. Only if the following 3 conditions are met. The conditions are there as you can see. In simple terms, the amendment seeks to impose Ugandans withholding tax on interest payment made by Ugandan resident companies on foreign issued debentures or loans that are ultimately used for business activities in Uganda or paid to banks, financial institutions, even when the funds are raised and interest is paid abroad. We reject the proposal due to its likely impact on borrowing in Uganda. This amendment should be rejected outright if it presents a harmful expansion of Uganda's tax jurisdiction over cross-border financial transactions and will have several negative consequences for the economy. One, these are the consequences, increasing the costs of borrowing. By imposing withholding tax on gross interest without allowing deductions of expenses, the effective cost of foreign debt financing will rise significantly. Foreign lenders, investors, will demand higher interest rates to compensate for the tax, and they will simply avoid Ugandan borrowers altogether. This directly raises the cost of capital in Uganda. So our argument is, once you put this 6%, if the foreign companies, for example, are lending you $100 million and their 6% maybe is 6 million. So for them, they will say, we want our 6 million irrespective of the tax regime in your country. So this 6% in the end is going to be put back to the Ugandan, the borrowers here in the economy, hence raising the cost of borrowing. The second issue will be deterrent of foreign capital inflows. Uganda already faces challenges attracting sufficient long-term debt and equity capital. Extending withholding tax to debentures issued and paid outside Uganda sends a strong signal that Uganda is becoming more aggressive in taxing offshore arrangement. This will discourage international bond issuances, syndicated loans, and other foreign financing mechanisms that companies use to fund domestic projects, including infrastructure, manufacturing, and agriculture. 3, violation of international tax norms and double taxation risk. Many double tax treaties, the DTTs, and standard international practices limit source country taxation on interest to cases where the payer is resident and the debt is effectively connected to the source country in clearer ways. The proposal risks creating overlapping tax claims, Uganda plus the foreign jurisdictions, leading to double taxation, costly disputes, and reducing attractiveness under existing treaties. 4, damage to business competitiveness. Companies seeking to expand or modernize operations in Uganda will find it harder and more expensive to access global capital markets. Local banks alone cannot meet the scale of financing needs in the growing economy. This amendment would particularly hurt large-scale projects in energy transportation, agro-processing, and other key sectors. The 5th one is about the broader economic impact. And I did explain this, that this is going to make actually borrowing in the country very expensive. Our recommendations, the amendment should be deleted from the bill. Uganda needs policies that facilitate rather than obstructing the inflow of foreign capital, maintaining a competitive and predictable tax regime for cross-border debt is essential for sustaining economic development. Broadening the tax base in this manner at the expense of investment and growth is counterproductive. If this provision is enacted, it risks doing more harm to Ugandan borrower environment and overall investment climate than a marginal revenue generation. There is an amendment that I had skipped. I want to take you back to, because I didn't explain it, clause 18, that is inserting section 150A, and we are proposing it to be deleted. That is right below part 8, because I thought I'd explained it, but I've noticed that I've skipped it, where we are proposing this clause to be deleted. This clause is talking about the income derived by resident individuals from foreign sources. The explanation is not there. The income derived by resident individuals from foreign sources shall be taxed at the same rate that applies to the same type of income sourced in Uganda. Right Honorable, when you look at Section 9 of the Principal Act, which defines a resident individual, there is the issue of the permanent home test, the physical presence test of 183 days, or the foreign employee, someone who is working maybe for government in another country. So what this amendment is proposing is that any Ugandan who is going out there or who is working out there, as long as he meets one of these three conditions under Section 9, in our view, to the economy. Why? Because we have very many of our young girls, many of our Ugandans who are going out there, who are doing cheyo. So in reality, URA is looking at the money that these people are making, because they are looking at, in their justification, they had looked at $500 million that is coming from majorly the Middle East as something that government needs to get some income from. But when you look at, for example, Saudi Arabia alone has 200,000 Ugandans. UAE has over 160,000 Ugandans. And most of them are doing the casual jobs like cleaners, the security guards, factory workers. And many of them are earning less than $260 per month. This is about 1 million shillings. So taxing such people, it's dangerous for us as a country, because many of these people, to save this small money, they are going through a lot. So you are targeting their income is not right, and in our view, we are completely rejecting this amendment. Or if it comes to the worst, at least let's have a threshold that needs to protect most of these local people, because many of them are making below 1 million shillings. So if you compare them to someone who is making 1 million shillings, for one to save this 1 million shillings, they are foregoing a lot. They are working endless shifts. They are maybe not having proper meals. They are not sleeping well. We've been to these countries and we've seen the conditions these people are going through. So we need this clause to protect most of our people. Well, the argument by the Ministry of Finance is that there are people who are investing in Dubai and other countries in real estate and all these other productive sectors that need to be taxed. But we shouldn't tax them at the expense of our people, because most of the money that is coming from those countries is coming from our domestic workers. Thank you very much, Right Honourable Speaker and Honourable Members. That is our minority report.
Thank you so much, Honourable Masaba Karim.
Madam, I want to thank you so much for the opportunity. Also, I want to thank the chair of the committee for agreeing on many issues, and the minority. Madam Speaker, I want to make just only 3 comments on this. One, Bujagari, we all agreed in this financial year that we give it 1 year so that the issues which we talked about are resolved. Madam Speaker, I want to reinstate the return on investment of those investors in Bujagari is already exempt. They don't pay, and that is allowed. The government, first of all, their shares, they are not getting any dividend, but for them, the others, they are getting. I don't know who negotiated that for Uganda government. And secondly, the money we are paying, even they have a report which says they have never produced the 200 megawatts of power. They are always under. And this is the thing we're saying, that the excess we're paying to them is the one, either they should have returned that money to us 100%, but we're saying for purposes of moving forward, maybe we take 30%. But that's the money, and this is being a collusion, Madam Speaker. I think the president needs to be explained further to understand this. I don't know who is the chief beneficiary in this, but we can explain it better. And I can tell you, this is not the cause of the excess profit is as a result of overcharge to us, not anything which is also coming from the consolidated fund. That's number one. Number two, Madam Speaker, with regard truly is a project to benefit all of us. But many years it has been around. But if you look at the initial people were there, this project changes hands every year in and out. Why? It is one of the profit-making institution. Everybody comes there after 1 year, he picks his money, he sells his share to the next person, because they know this is where they are milking from government of Uganda. Unless we Ugandans get up to deal with this monster now, then we're in a big problem. And that's why we're having power costs too high. Madam Speaker, you cannot tax a private asset. A private asset is a private asset. And that must be known. That's why it is called a private what? Asset. It is not for purpose of business. But however, when I buy a car from Zaveria, I pay transfer what? Fee. If I buy land from Amos, I pay transfer what? Fee. But how do you come again and say that from that same land, the money I've got, I should pay 6 what? %? That is criminality of the highest what?
You should withhold 6%.
You withhold 6%. That is the criminality of the highest what? Highest order. Madam Speaker.
Maybe Chairman, BCU, maybe we would first understand from the sponsor, which assets is he looking at? You first wait, let me first hear from the sponsor.
Speaker, I want to help you. If you read the bill of 2024, the assets were there. For this time, they hid the assets purposely. If you see the bill of 2024 was talking about land in
Honorable Minister, which assets are you wanting to tax? If I'm selling a car, my car.
Right, Honorable Speaker, our method of work is transparent. We don't hide anything. As Honorable Mafabi is attempting to allege. Madam Speaker, Section 3 of the bill proposes to amend Section 20 of the Income Tax Act in subsection 1 by inserting paragraph BA, provide for taxing income derived from disposal of a non-business asset as property income. And this income includes income derived from the disposal of a non-business asset as property income. This amendment ensures that income from the sale of non-business assets such as land, jewelry, shares, and precious metals is recognized as taxable income under this Act. It is necessary to support the proposed withholding tax in clause 13 of the bill on such transactions, since the income must first form part of gross income to be chargeable income. Madam Speaker, further to this, currently, the capital gains tax mainly applies to business assets, with gains taxed as part of business income. Non-business assets are largely outside this framework, creating a gap in the tax system. The proposal addresses this gap by bringing non-business assets disposals into the tax base. The clause introduces withholding tax on the gross payment for such assets as a practical complement to the capital gains tax, Madam Speaker. So in other words, the capital gains tax, for example, if you sell a business, you are a manufacturing company, your valuation of the business is, let's say, 10 billion, and you sell this business at 20 billion. The difference between the value and the market price is the gain. There we charge the business, we charge the capital gains
But you're
tax.
talking about non-business.
Now, yes,
those are business
please.
assets.
Honorable Choma, if you want to speak in the House, through the Speaker.
Honorable Minister, just explain to the Ugandans out there what the non-business assets are, for them to understand.
Madam Speaker, in respect of land, we have companies which are in the business of buying and selling land. You buy land today in PG, for example, at 100 million per acre. You subdivide it and start selling, and you realize 200 million from this acre. So the difference between the cost of the land, 100, and the profit of 200, the 100, we think we should charge the capital gains.
But that's a business.
No, so I think what we need to define, as long as it is useful information, as long as
I give all the useful information.
you are reading what I'm reading.
Yes. Madam Speaker, I want to give the minister information. The information I want to give, the minister is laboring for nothing. Dividing land and selling it is a business. And let me tell you, why we're saying you're hiding information, that is coming as a secondary. We have here a bill of 2024, which clearly even came up. Let me start subclause 9 says, for purposes of this section, non-business asset means assets specified in subsection 2 and does not include business what? Asset. And what you did in business asset in clause 2, you said, a tax shall be charged on gain for disposal of non-business asset at a rate of 5% on the gain computed under subsection 4. You listed them. Now what did you list? You listed shares of a private company, land in cities and municipalities, except principal place of residence, rental property that is subject to rental tax, under subsection 5 of this. So if you're in a place which is rural and you're renting your land to somebody and you sell it, it will be brought here. If voluntary disposal of non-business assets through auction in court, order, mortgage, divorce, even the mortgage and a divorce, you brought it here. Settlement and spouse separation agreement. If you separated with your wife. No, but I'm coming so that you listen to them. I'm coming. So now what I'm trying to say that you are a very bright boy. You are denying that you never hid information. I'm giving information that my brother you hid information. If you want, you read from peg 4 to peg 5 of the income tax amendment bill.
Can we first dispose of my argument? Can we first dispose
now,
of
the
my
argument you're bringing, my brother,
yes.
A business asset. If I buy land today and I divide it, then tomorrow, that's my motive. Then after selling again, I buy another one and I divide. It means I'm trading in what? In land. If I buy second-hand cars, listen again.
So the question here is, if you are in this business, should you pay tax or not? The answer is you should pay. But are we paying or we are not paying? We are not paying. Let us be sincere.
Chair, Right Honourable Speaker.
I am on the floor.
The Speaker has given me.
No, I am
the Speaker
on the
has
floor.
given me.
No, please, can I
let the
conclude?
minister finish.
Can I conclude?
Let him finish his
I
explanation.
know the rules of this house. Madam Speaker, the point we are making, we agree. My ancestral land in Hamurwa, where I was born, should not attract tax. But if we have business people who are in the businesses of trading in land, whether individuals or companies, and they are making profit, we should find a way in the law of charging tax from them. So the question we should
That is okay.
yes, the debate we should be having now
Maybe we
is
need
how
to
do we
define.
separate? Yes.
Maybe we
how
need
do
to
we-
define
Yes.
what a business asset is and a
I can take
non-business.
Thank you, Right Honorable Speaker. It's the information I wanted to give about the business asset. When you look at the law, yes, when you look at the law, section 2, Right Honorable Speaker, when you look at the law, section 2, and the Attorney General was in, but he has stepped out. He would help our minister very well. It defines a business asset. Business asset means an asset which is used or held for use in business, and includes any asset held for sale in a business or any asset of a partnership or company. The non-business asset is everything else that is not a business asset, according to the law. And now the minister,
Yes.
even in his explanation, he even
Yes.
gave an example of jewelry. Meaning, even my watch here, if I bought it 1 million shillings and I want to sell it 2 million, the minister wants me to pay a tax on that. Yes, that is how the law is.
That's
written.
not
Yes.
what is supposed
The law as it is, someone who is holding a business asset pays tax on that. So if you had said that you want to tax on a business asset, that would be understandable. But when you phrase it as a non-business asset, even when I'm selling my TV at home and I'm getting a profit on it, you want to tax it.
Now, a non-business asset are personal, non-operating items held by individuals or companies that are not part of the core operations. Often targeted at 5% disposable tax on the gains in specific jurisdictions.
Speaker, what the minister was raising about land, it ceases to be a business asset. It is a commodity for trading. Let me make it also understandable. If my business is to buy land and sell, so my trading stock is land. As far as, yes, so if my trading stock is land, is different from Karim, who keeps his land and sells from different. So for me, I am subjected to tax because I'm trading in what? You ask me.
Thank you, Right Honorable Speaker and Honorable Mafabi, for yielding the floor. Now, I am not in the business of selling and buying land, but I have invested. I have saved my money in land with an expectation that this land will gain more value and give me more money in the future. The case in point, I want to give you my personal example. In the year 2009, I bought land, an acre of land in Namave, Chiwanga. I subdivided it in 2015, thereabout, and I was selling each plot at 40 million. I bought an acre at 60, and I subdivided it, got 8 plots, and sold each plot at 40 million. The question is, did I pay any tax? The answer is no. But the question is, was this fair for me not to pay tax on the gain I made?
Honorable Minister, will you have the capacity to monitor all the non-business assets? That's number one. Because like if you're also looking at non-business assets that you wish to benefit out of, I plant trees now. And after a particular year, I will be able to get more money out of those trees. Are you going to tax that?
Madam Chair, the minister needs to understand that we are in agreement with him when it comes to business assets. And there should be every measure to make sure that his ministry identifies everybody who is in a business and is making capital gains tax. And that is an administrative issue. If he's not registered, you have powers to forcefully register that person and say you are in this business, we need to tax you. What we are asking you, Honorable Minister, is the scope and your capacity to implement. You are zeroing down on land, but Madam Speaker, you have talked about trees. The law does not provide an exclusion. Supposing someone has land and he sells it to have to solve a medical problem, do you want to tell me that he has gained? Secondly, how are you going to administratively go into every household in this country to know that Mafabi has bought my chairs, I have earned the income, I have sold my watch, I have earned income? We need to pass a law that can be administratively implemented. The cost, the average cost
The administration of the law.
of the law.
Yes.
Madam Speaker, international practice requires that every tax, if you incur more than 3% in collecting that tax, it is not viable. So what is not clear, Madam Speaker, from the minister is when you say non-business asset, you are casting a net into the unknown. And we need to understand that this House cannot legislate on administrative issues. And therefore, our thinking as a committee, Madam Speaker, was that perhaps if the ministry was looking at land and people are involved in selling and buying land, it's a different study. Go and study it properly.
Real estate.
And come back next
Vis-a-vis,
year.
if I want to sell my house,
Yes.
I'm not selling it for business.
Yes.
It's my personal property.
Come back next year with a refined proposal when you have studied, and then we look at this issue again.
So, Madam Speaker, I want to make that one.
Honorable Nathan, which clause was that, Kumbe?
Madam Speaker, that was clause 3.
Okay. I put a question that the Income Tax Amendment Bill
Yes, it's
2026 be read for the second time. Those in favor say and the contrary nay. The ayes have it. I want you to discuss clause by clause.
The Income Tax Amendment Bill 2026, Bills Committee stage. Clause 1.
Clause 1 has no amendment. I put a question that clause 1 stands part of the bill. Those in favor say and the contrary nay. The ayes have it.
Clause 2.
I put a question that clause 2 stands part of the bill. Those in favor say and the contrary nay. The ayes have it.
Clause 3.
Amendment.
Right Honorable Chair and colleagues, the committee proposes that we delete clause 3. And justification is implementation of a tax will cause considerable administrative challenges as the traceability of transactions involving non-business assets will be difficult. And 2, non-business assets are not used in trading or business, and their disposal has no profit motive. Any gains from their disposal should therefore be exempt from tax. And 3, further still, non-business assets are usually disposed of for personal reasons, for instance, payment of medical bills, and these therefore should not constitute a tax base. I beg to submit.
Minister.
Madam Chair, the chair of the committee has brought in something sentimental. selling assets to pay for medical bills. or school fees or any other personal purpose is sentimental. However, the principle that people who are in the business of buying and selling land, if they make gains, should be taxed is okay. But because at this moment I cannot easily differentiate between those who are selling for sentimental purposes and selling for business, I want to concede. I will come back next year after I have clearly defined those who are selling for making profit and those who are selling for other purposes.
Thank you. I put a question that clause 3 be amended as proposed by the committee. Be deleted as proposed by the committee. Those in favor say and the contrary nay. The ayes have it.
Clause 4.
Clause 4.
Madam Chair and colleagues, the committee proposes as follows. Clause 4 is amended in subclause A3 by substituting for the word 5 million United States dollars the words 1,500,000 United States dollars. Justification: to reduce the threshold for citizens from 5 million United States dollars to 1,500,000 United States dollars. I submit.
I thought that was a consequential amendment which we passed in the hotel.
Yes, he has to pass it formally because since we had agreed the other side and this side, so no, you wait. I'm actually supporting you. So the position, since we passed it the other side, then it has to stay the same this side. It's consequential. That's why I didn't present it in our minority report. Yes, but the same section has the issue of A1 of Bujagali, so we also have a minority on Bujagali. Yes. No, that is a dark closer.
So for a part 3 stands as it is in the bill. So 4.3 stands as part of the bill.
As part of the bill, yes.
And then 4.1.
And 4.1.
Okay, let me first put a question on 4.3. Those in favor of 4.3 standing as part of the bill, say and the contrary nay. Let's have it as amended.
Yes.
No, it's not.
We are taking the position of the minister on that.
We are taking the position of the minister.
Yes.
It stands part of the bill.
Yes. So, Chair, our proposal is to delete part A1, which is substituting for the following: the income of Bujagali hydropower project up to 30th of June 2032. We are rejecting and we are proposing that be deleted.
Why don't we leave the chairman to move? He has not moved it.
Madam Chair, he has read it. He only brought amendment. On this one, he had agreed with it.
So you're okay with it?
Yeah, for him it was okay. And even Katesh, who was the chairman of the committee, which said this should not be, was also agreeing. That means there's double standard in this house.
It was not cast on stone.
So, it's not personalized. These are things why should the parliament give people work to do. We come with a report. It is passed here. It's adopted. Then instead of implementing as we have agreed, even the chair of the committee turns and runs away. Madam Chair, this is being unfair. Last year, this financial year, we said we give it what? 1 year. And the year we gave it, we said, now government goes and renegotiates and corrects those issues. And also Bujagali to refund the money they took in form of taxes before the exemption came up. So, Madam Speaker, Madam Chair, I would propose that this house, let us not be taken for granted. I would say we delete this as the minority committee has proposed, and Katesh, who was our chair, should come up and support this, that we delete
Let me hear from Honorable Katesh.
Right Honorable Chair and colleagues, During the committee's meeting, and I would like to remind my brother, Honorable Karim, that the public with which we interfaced were very passionate about extending the exemption for many reasons, especially our manufacturers, saying that the rate, like I read earlier, Right Honorable Chair, has reduced from 8 cents to 6 cents. So that's why, as a committee, we envisage that an extension of this exemption to 2032 will further reduce to 4 cents. And besides that, it was explained that the performance of the project has increased to over 80% in terms of delivery of power. Secondly, we acknowledge that the agreement, the power purchase agreement, is where the error was, and we cannot change it. Why should we therefore cause this to our manufacturers by causing an increase in the tariff?
Honorable members, the problem that we have in this country, when we make a wrong agreement, purchase agreement, now we start complaining afterwards. It was a raw deal, very bad deal.
The Honorable Nandara was my member. And the Honorable Nandara has been in Parliament more than myself. And perhaps he was there undertaking oversight when some of these agreements were done. Madam Chair, while our position has been taken, we have to be mindful. Honorable Nandara knows that the biggest problem we have with Ujagari was the rate of return and the loan. By us rejecting this proposal without dealing with the issue of the loan that brought us into this problem, we'll be shooting ourselves in the foot. Therefore, it would have been ideal for government to bring this proposal with an additional proposal to pay off the loan. Then we would have a problem. But right now, the challenge we have from the minister has been here explaining the impact of tariff if we make this proposal. And the private sector, which appeared before the committee, explained that their worry would be the rise in tariffs. So I have not changed from my position. But the reality is that we signed agreements, bad agreements, and I still insist that if government has a way of getting money in the next 5 years to pay off the loan, to buy off the loan, then this matter would be resolved once and for all. But for now, we have to allow this to run because it is consistent with the agreements that we signed.
Madam Chair, the Honorable Katasha, when he's talking about a loan, Nandara being, we have objected this since 2014. In 2017, when these people discovered that the end had come, do you know what they did? They decided to go and get more money. Yet we had come to the end, the other first loan had been not paid. You saw it in the report. Why would you go to pick more money when the money has been not paid? And the two, you are collecting dividends. First of all, you're getting return on investment, which you should have got dividend. You are getting again dividends. So you're getting twice. This is really, Madam Speaker, I want to tell my brother Katesh, it's not the loan issue. It is a criminal act which must be dealt, and Parliament should come here and deal with it. Even when the Auditor General audited, he said, number one, the power doesn't even reach 200. But the claim is what? That's 100%. Now, even he has also agreed, it's 20%. But we are paying for what? 100%. Yeah, now 88, but we're paying for 100%. Even it has moved. It started from 40 going up. We are paying for what we are not getting. So, Madam Speaker, why we would have done this? Now we have got Karuma.
We are paying for the mistakes that we made in the power purchase agreement. We made the mistakes. It may not be you, Nathan, but the officers that made mistakes are causing Ugandans.
Yeah, Madam Chair, but that's true. If we made a mistake, we said you produce 100%. Then you produce 70%, 60%. You have failed also on your duty. In fact, that honor alone makes the agreement to be what? Terminated.
One of the recommendations we made, because if it is about the production capacity, the Committee of Natural Resources, which provides oversight, should be able to look at this sector, because there are commitments, and the Minister of Energy is here. Periodically, the regulator should be looking at the performance with respect to the production capacity. So, Honorable Mafabi, I agree with you, but don't discount the major issue is the high return on investment and the loan that was involved, and therefore we should pay for our mistakes.
There is an order.
Madam Speaker.
But you people,
Madam Speaker, the problem we have in this country is that we must reevaluate the education system we have. Some of these universities, including Makerere, where I went, and taught us economics, should be in position to even recall some of the papers. Yes. If you are an economist, no, I'm speaking generally. If you are an economist and they are in Ministry of Finance, we are taught the same economy. You must belong to some economic theory. Are you a development economist? Are you a classical economist? But now we are having retardatory economists in this country. Through their proposals, they bring in the bills, and some of the debates here. This parliament sat and made a raft of resolutions. Madam Speaker, if you look at the Hansard of 2025, and some of them I can quote you. You even say, yes, you said,
I did not say
we are here. When you were convincing us that time, you said, this is 2025. We are here, we are not going anywhere. This is on the record of Parliament, the Hansard. Again today, Madam Speaker, you have also said that these are bad agreements. The same thing you said in 2025. You mentioned Omeme, you mentioned Bujagari. I want to submit that this Parliament...
First put the order.
Yes, I want to submit on that. Yes, I have to... Yes, I want to submit, Madam Speaker, that for a chairman who led an ad hoc committee and came with a raft of recommendations to come here and stand and entirely disown his own report, dismantle it by his submission, being a former commissioner at Uganda Revenue Authority, in customs, and who left URA with a record that the public are still interested in.
Actually, URA, Mrs. Katesh.
That's what I'm saying. We are really interested in his service at URA and the questions he has.
Honorable Katesh did a very good job in URA.
Yes. Which job you know how it ended. But my point is he in order?
No, it ended well by him becoming a member of parliament.
I didn't say it ended badly. I didn't.
Yes.
So, my point of order is, for a chairperson that this parliament spent resources to facilitate him and his 8 members to go and do work, and that expenditure had not extracted it, I would have put it per capita, per MP, how much you spent to do this report. To come here and we debated this report, we adopted it, government made a commitment, and he has come here completely to make a turnaround. Is he in order? First of all, without bringing a motion to amend the resolution we passed, and just debate in the negative and disown that. Is he in order?
Honorable Dur, that report was made by a team of people, including Honorable Nathan Mafabi, Honorable Karim, and after seeing what could have unfolded, we are saying, we are looking at the purchase agreement. After seeing what could have unfolded, that's why he's making a U-turn. So I mean, it was not cast on stone. You'll debate. Don't worry, Jonah. You'll debate.
Madam, we want to thank you for being around, as you said. And we want to say that if Honorable Katesh was making a U-turn, he would have invited his members, they go and make a U-turn together, not him to do alone. This is very dangerous for a chair of a committee to do a U-turn without members. But Madam Chair, almost just 1 minute, don't worry.
The tenure of the whole committee is time bound.
No, it doesn't matter. So that's why I say, Madam Chair, now this was a report of Parliament. Again, the Parliament could have sent another one to go and review that this committee did a wrong job, so they get to send up this. But it came up with recommendations, which all of you agreed. The Minister of Finance agreed.
Honourable
The Attorney
members,
General agreed. Yes, Madam Speaker.
honourable members, we have had all the debates. We've had all the issues. It is just for this House to determine whether to give the extension or not. You get it, eh? Whether for the House to give extension or not. Let me hear from somebody who has not said a word. Honourable Mpindi. Then I'll give Jonah, I'll give Chairman, I'll give Doctor, and give my senior youth.
Thank you, Right Honourable Speaker. Right Honourable Speaker, we are here on behalf of the people who sent us to Parliament. When we are processing this amendment, we invited stakeholders, and almost everyone who showed up in the committee was supporting the move of extending the 6 months. Unfortunately, Honourable, the 6 years. Unfortunately, Honourable Nandara was not in the committee. So some of us asked them questions.
He was in Washington.
Sorry?
He had gone to Washington.
He was in Washington. Some of us asked them questions, and we are saying, if you don't extend, for us in business, we are in trouble. Now, basing on that, we came out with that. It is not that Katesh has turned around. Yes. It is because of the people that we represent that said that in the committee. That is the information that I wanted to give, Madam Chair.
Thank you. Jonah?
Thank you, Madam Speaker. Of course, I oppose the extension, and I have the following reasons for it. First of all, I'm getting really excited that the committee and then my brother has submitted that stakeholders who appeared before this committee were all in support. I'm happy if this Parliament has started taking the views of stakeholders, that once stakeholders appear before the committee, all of them, and then they support the text, and I'm really pleased. And going forward with other bills that are going to come, Madam Speaker, I put you on notice that once stakeholders have supported or opposed. No, I don't allow clarification now at the end. Let me speak, because that's what you said, that all the stakeholders who came. Yes, okay, let me finish. So I'm really pleased that now we are beginning to take the views of stakeholders of this country very seriously. Secondly, Madam Speaker, we had made some recommendations. It would be prudent if government clarified on how far they have implemented some. I'm going to point out only two. The first one is that the Minister of Finance, an amount of the Minister of Finance, an amount of $2.83 million was covered in what I could call fraudulent transaction within the Minister of Finance. And we recommended that they should recover that money and tell us. I don't know how far they have gone.
Still on Mujagali?
Yes.
Okay.
It was a finding. We had also found that there were excess payments of $342 million. We need an update on that. He made commitment last year that you pass, I will come in a month or two. We had made a discovery that insurance was charged an amount of $163,000 in expense as a loss. And we had asked the government. So even if we are requesting for a waiver, this House and Parliament should be taken more seriously. I'd expected either the committee or the minister to highlight these items.
Honorable Jonah, I can see the Minister of of no, the minister has information. There are questions that are answered, which old man.
Right, Honorable Speaker. A lot has been done in regard to this. One, audit was done. A forensic audit was done on this, and the report of Auditor General is available for this meeting. Two, the tariffs have continuously gone down because of the waiver given to this. It has actually reduced to 6.5 as we talk. Removal of this will revert all the gains and will threaten what we are talking about, the tenfold growth in the economy. So I actually, Right Honorable Speaker, instead of coming here yearly, I actually appeal to the House to do it once and we actually go for until 2032. I submit.
There was something I was asking about the $312 million.
The 22. What? That's for finance to submit. Only how we are now servicing the loan.
Madam Speaker, let me conclude. This shows how the front bench receives recommendations from this parliament. And because we have given them a leeway, they tend to exploit. You can see they are not even aware of the commitments that they made, including the minister who is here. But I want to suggest that in the event, very unlikely event, because the House is also not properly constituted, in the very unlikely event that you are persuaded to take this direction, 6 years is untenable. Even a term of government, if you interpret the Constitution very well, the term of government is 5 years. For you to move beyond this term of office and the rest, I think it's a bit suicidal. So if we and this parliament is going to be here, so in the unlikely event, and I don't know the instruction, Madam Speaker, you have always.
I am just reminding him that yesterday I said I'm not going to make a decision for posterity because I'm not sure whether I'll be here for the next 6 years. I will be here for 5 years. So in the likely event that we are going to make changes, we make changes for 5 years. We cannot legislate for other people who will come here. You get it, eh?
Madam Speaker.
I am just on the year,
Madam
but
Speaker,
I cannot go beyond the 5 years.
Madam Speaker, actually this country has taken legislative notice, the notice you gave to the country that in 2031 you will be out of politics.
Actually, I will be in my village.
Yes, and you don't have any other ambition. So what we are saying now here, Madam Speaker, is that since the Parliament is going to be here, in the unlikely event, let's not go beyond 1 year. So that if they want a full term of 5 years, next year they come, then the other Parliament can deal with them in that 5 years. But I just plead that in the unlikely event that we are persuaded, and we are really being gracious, because last year, remember we had proposed 6 months. The committee had recommended 6 months. And then we said, okay, let's do it for 1 year. Let's do it for 1 year.
But at least I'm aware and sure that I will still be a speaker for the 5 years. These 5 years. So
thank you very much, Madam Chair and the colleagues. I have seen members, and I've heard in this House, who are trying to kind of move us to a direction of being insensitive to the earlier recommendations and resolutions of Parliament. Our Committee of Finance, Planning and Economic Development debated very extensively this particular matter. We actually looked at both sides. We know we actually almost between a hard place and a rock. But we had to look for the best alternative, because even when we received from the different stakeholders the views, they were all pointing to one fact, that the extension of the waiver to Jagali has greatly reduced the rate of the tariff. And if this is not granted, the tariff will immediately go up. And this will affect every sector of the economy. We know this is not the only thing that government must do at this particular point in time. But to be able to sustain the levels of growth of this economy, we actually took this particular direction. The point that has been supported by Honorable Kateshumba here is not his own. He's speaking about a position of the Committee of Finance, Planning and Economic Development. So he's right in that respect, because this is what we agreed, and that is, we support the waiver because it's going to help the economy. I beg to submit, Madam Chair.
Thank you. I talked about senior youth, but senior youth is... honourable members, you've heard. Me, I'm going to put a question. Nathan, you've over-talked. You've made your point. Everybody, even in Bugisu, has heard. Bugisu Cooperative Union. Honourable members, I am putting a question that clause 4 stands for the whole of 4. The whole of 4 stands part of the bill. Those in favor say the contrary nay.
No. Yes, she has not yet put the second question. I'd moved an amendment which the House can receive and deal with it first, then you move. Because my amendment was that we give 1 year, which would read, instead of 2032, we say 2027. It is before the House can deal with it, and then so that the next Parliament can, my justification was, then the next Parliament can come, since they have the whole 5 years, the same member, the same speaker, supposedly, and yes, so they can deal with it. I am putting a question.
Honourable Minister.
I want to oppose.
Honourable Minister, I am putting a question that the House adopts the amendment of Honourable Do. Those in favour say on the contrary nay. The nays have it. I am putting a question that clause 4 stands part of the bill. Those in favor say on the contrary nay. The ayes have it.
Clause 5.
Clause 5. I put a question that clause 5 stands part of the bill. Those in favor say on the contrary nay. The ayes have it.
Clause 6.
I put a question that clause 6 stands part of the bill. Those in favor say on the contrary nay. The ayes have it.
Clause 7.
I put a question that clause 7 stands part of the bill. Those in favor say on the contrary nay. The ayes have it.
Clause 8.
Clause 8.
Madam Chair and honorable colleagues, the committee recommends that clause 8 be deleted. Justification: the proposal contradicts the fundamental principle of taxing profits and not turnover. 2, the proposal will make companies that are already making losses to face further financial strain and may lead to closure of businesses. I submit.
Clause 8 deletion. Minister.
Madam Chairperson, clause 8 is about businesses which carry forward tax losses in perpetuity. A business remains in operation, it is making business profits, but when it comes taxes, it is always registering tax losses. the question which has been here in this house has always been, why can't URA audit these companies to ascertain whether they are making profits or losses? And URA has admitted that yes, they have capacity to audit, but they don't have capacity to audit everybody. And as a result of this, why we are asking for this provision to be in the law is that after 7 years, if you remain in operation and all the indicators is that you are a profitable business and you cannot declare that this is how much I am making and I can give you this tax, we tax you at a rate which we have proposed of 0.5% on your gross income. I think, Madam Speaker, Chair, this is fair. Because
Honorable Minister,
to be doing well and you don't
Honorable
pay
Minister,
tax forever.
if you've been making losses and then after the 7 years you want to tax at 0. What? What are you taxing?
Honorable,
What
before
will
you
you be
answer,
taxing?
can I just add to your question? Madam Chair, the Minister should be very practical. On one hand, the income tax provision has given companies tax deductions, capital allowances that are actually creating this situation. And the purpose why they were brought in the law is actually to promote business. It is not true that any company that is making taxable losses is not contributing to the economy. They could be making business profits, expanding, creating employment, and therefore you should not look at them as if they are creating nothing for the economy. Secondly, Madam Speaker, this provision could actually orchestrate more tax planning and losses for government. Because if someone is carrying losses in perpetuity, and you don't audit him and overturn those losses, and you just create a simple measure of 0.5%, you are actually telling someone that you are comfortable with 0.5%. And you may never do what? Fine. Yes.
I want to give you, Honorable Kateshe. Madam Speaker, there's a difference from a tax loss. I want you to listen to this. There's a difference from a tax loss and a profit. I can be making a profit, but because of the capital allowances you have given, they lead me to a tax what? Tax loss. So if you do it, you see, you are my brother, you are my member. You know it in accounts. I do the accounts, I make a profit. Because let me assume my depreciation rate is 5%. Let me just give an example. My depreciation rate, I'm the one determining 5%, I am making a loss. You give me a capital allowance of 50%. It means if I've made 2 million, that profit will be turned in a tax what? Loss. And it will be carried forward. And because my returns are too small, my profits are too small, and you have given me to write off something within a short time, it will take a longer period to recover. That's what the information.
Information is very clear. But Madam Speaker, you are an investor in schools. Take an example of someone who has invested. There are people who are building hotels in this town, big hotels. It is very clear, even if you do a study, that such people will not make taxable profit in less than 10 years. If someone has a hospital, how long will it take for them to recover? Madam Speaker, government, if you want to deal with the taxable losses, as Honorable Nanda has said, then we must go and revise the schedule of deductions that you have created. But you cannot give with one hand that creates a problem and then you take with the other. Finally, Madam Speaker, some of these measures, we must be mindful of the message we are sending. This country wants more and more investment. If you tell someone that, come and invest, you have given them investments in the investment code, and then you say after 7 years, I will look at your gross income, even when you are in losses, and I tax your gross at 0.5. The message you are sending, Mr. Minister, is that you are you are likely to make Uganda a less competitive destination for investment. How much money are you looking at collecting here? Let us empower you and the administrators to audit these companies, overturn these losses into profits if you are suspecting, but don't create a problem that can destroy the economy and fail to attract investment.
Madam Chair,
Thank you.
in addition to that, first of all, these people, what you are looking around is only the direct tax. But the indirect taxes are too many. Pay as you earn, the consumption of the goods they are taking, there's VAT on them. They also provide, you see, services which you may need. I'll give another example. There are businesses which could be making a loss here. They are helping other businesses to make a what? A profit. The moment you close those businesses also which are making a profit, I can tell you there are so many indirect responses you can get from businesses which are making a taxable loss. Mark, are you a taxable what? Loss. You're saying, why are people investing? People are investing to create jobs. People are investing to create goods for a country.